Hello and welcome to a lesson on liquidity. And today we're going to discuss a little bit more on liquidity, which is a topic we've actually covered previously. And first of all, let's define what liquidity is. Liquidity refers to the degree to which an asset or security can be quickly bought or sold in the market without affecting the asset's price. I guess how quickly can we run for a level without having a significant impact in the value of an asset is what we define as liquidity. Now, previously we've talked about internal liquidity and external liquidity, and just to rehash the things we discussed already, we talked about how you want to pair internal liquidity runs to external liquidity runs as an objective, and you also want to pair external liquidity runs to internal liquidity runs as an objective. And we're going to talk about one of our algorithmic principles for price delivery or liquidity delivery. And we're also going to discuss low resistance liquidity runs. Now, price is designed to always seek the path of least resistance. And this is how we get the term a low resistance liquidity run. A low resistance liquidity run would always be in direction of the daily order flow, because that is where sponsorship occurs. The path of least resistance would always be the path in which the institutions are sponsoring. Now, if we go back to the previous example we used on the last lesson, which was USDCHF, where we discussed this trade idea looking for sells. The reason why you see this very fast and quick delivery lower is because the path of least resistance is the path in which institutional sponsorship is occurring, or the path in which price is being sponsored, which is on the sell side. So you would classically see an aggressive run lower or an aggressive displacement when we are on the side of institutional sponsorship. And this is one of the measurements, and this is something you can also add to your trade management protocol. This is one of the measurements you can use to validate the validity of your execution. One of the ways you can validate the validity of your execution is how willing price is to displace. The willingness in price to reach for a level indicates the type of liquidity pool there. Now, if a liquidity is a high risk in liquidity run, typically what you would get is what we call a deferred delivery. We're going to discuss what deferred delivery is, but let's use some drawings to communicate what I mean. Now, like I mentioned before, the path of least resistance is always going to be the low resistance liquidity run, but this is not all the time. Now, the more back and forth you have in price, the more difficult it could be for price to run through an objective. So now let's assume here in this example that our daily order flow is bearish and we're looking for weakness in price. So price runs up into an high time from premium array where we're expecting sponsorship to come into the marketplace and see displacement lower. And then the displacement ensues and starts, and we start to see the market follow through with that run lower. What we would generally expect is sell side liquidity to be where price should be reaching for order pairing. So the market should be expanding down here because there would be available orders down here. Then we can pick up in price and allow for counterparty mitigation or counterparty liquidity pairing. Now, because we have a ton of back and forth like this in price, and you can see here we had a short-term low, and any buys in the marketplace were stopped out, and then the market ran higher, and any buys in the marketplace were stopped out, then the market aggressive ran higher. Now, at this short-term low, there are sellers who are trapped in price. So we have sellers trapped in price as the market runs higher for a daily premium, where institutions come in and then there's transactions facilitated We see the market follow through with the downside expansion. Generally, when we see runs on liquidity like this prior to a retracement up into a level for higher time for sponsorship, I usually will class that as a high resistance liquidity run. Now, what is special about this is that you oftentimes can get what I call deferred delivery, which is classic with high resistance liquidity run. Now, remember, I said generally, not all the time, but generally, the path of least resistance will be always in direction of daily order flow. Right, I think I actually messed that up. The path of least resistance would always be in direction of daily order flow. So the market will always seek the path of least resistance, which is if daily order flow is bearish, it's going to seek sell side. If the order flow is bullish, it's going to seek the buy side, because that's where institutional sponsorship is driving price up or down into. But now that does not mean price cannot have a difficult time running through a liquidity objective. The statement, the path of least resistance will always be in direction of daily order flow, puts things into context, because the market will always eventually run the liquidity in direction of daily order flow. Will always, never fails. But there are also ways you can anticipate the market not running a liquidity and understanding what's going on. So you don't go and say, okay, well, the market is showing an unwillingness to run this liquidity, so this is a high resistance liquidity run, and I want to see a reversal from here. You don't go like that and use that as an example. So let me explain what I mean. You can see here, because of all the back and forth, and not only the back and forth, and what also is classic, a characteristic with high resistance liquidity run, is the run on stop prior to that low or high forming. Okay, and the back and forth, or the nature of delivery prior to the formation of that high or that low. Now you would go in, let's assume that this is New York session. And then you go in during New York, and classically what you expect during New York session is a run for sell stops. Why? Because we're very close to that sell side liquidity goal, and you're looking for a lower time frame premium to sell short. And this is classically what you expect. Market to run in the direction of daily order flow and run for sell side. Now that's typical, and that's classically what you would come to expect of price delivery. But it is not all the time this actually happens. Because this is a high resistance liquidity run, the market will try to run for that low and then fail. Then either consolidate or show a little bit of a retracement higher. Now what this does is, a lot of people look at this and say, well, because the market is rallying higher, we are now bullish in price, because we're not seeing a willingness when I run below the low here. All that's going on is something we call a deferred delivery. And what that simply means is the market is deferring the delivery to build in more sell side liquidity for a later time. And a lot of times it could be the next day. So if this was New York session and during London close the market continues to retrace like this, classically I would expect London session of the next day or New York session of the next day to sit around on liquidity, because this day engineers sentiment. Right, so what would happen typically is this is the end of the day here, and then this is going into the start of New York session. So let's just use a dashed line to London session the next day. I'm going to use a dashed line. Then what the market typically will do is the market will consolidate, and then go into London session, it starts to run lower and it goes very aggressively. Now if this was a low resistance liquidity run, the market would classically, you should majority of the time expect the market to just run through that liquidity, right? But now what are the signatures of a high resistance liquidity run? The number of times we trade around a mean price with, and we don't see a willingness in price to want to displace, or see a failure in price to want to just expand higher from there. Now, classically, when you want a short-term low to form, you want something like this. Well, very clean lows here, and the market runs higher. So let me just clear up all of this annotations and describe what I'm saying. So for a classic low resistance liquidity run in direction of daily order flow. Now I'm not talking about against order flow. You never want to trade against order flow. Now there are ways you can counter trade against daily order flow, but that has to be a short-term scalp or a TGIF, which we're going to discuss. What a TGIF. I think we've actually discussed what a TGIF setup is. All right. So here, what you want to see for a short-term low, which is a low resistance liquidity run in direction of daily order flow, is you want to see the market run to a low and reverse from there and retrace higher. And then we have this low here to contend with. And this is a classic low resistance liquidity run. And in the future, the market should come down there and clear out the objective. That's what we actually saw on, I think that was just CHF, the example we used on the video yesterday. Alright, so you can see here, the market runs lower. Very clean lows here and runs up into a premium, clearing out buy stops, turning out into a daily bearish order block, and you can see the willingness in price to want to run through the lows there. No stalling, no unwillingness in price to want to run below that, just smooth price delivery. Now what I want to see going forward is how, if we try to attack this low one more time, how willing we are in price to run through the low without first seeing a bounce and a run on internal liquidity with this one. Now the reason why this one is a very clean low here is because it runs lower, the market goes higher, there was no trapping of sellers down here or neutralizing of buyers, the market just runs lower and then runs all the way up into a premium. So we know that this is the path of least resistance because we're bearish. Okay, but now if you look at this, let's not use this one. Yeah, if you look at this low here, which I was talking about, which is similar to this one, you can see prior to the low forming, we ran lower, and guess what happened? We trapped sellers. So sellers below the marketplace are now trapped, and then the market runs for buy side. Now the market runs up into an higher time frame premium where we're expecting bearishness coming into the marketplace. Now this is the low that we would expect a market structure shift looking for, because this is the last major swing low prior to run higher. So obviously this is the low we're looking for a market structure shift, looking for the market to break through, and then we shift our sentiment to bearishness in price. What you can see here is watch how many times the market fails to actually run through this low here. It goes all the way down here, you can see a bounce and runs internal liquidity. It comes all the way down here, and then you can see another bounce for internal liquidity. And now while this is an high resistance liquidity run here, we also have another high resistance liquidity run down here, which is where we cleared out sell stop, okay, here, and you can see how excuse me, you can see how the market tries to run for the liquidity and actually fails, and trades a little bit more and clears out internal liquidity, which is this one and this one, before eventually running through all of them. And this is what you call a layered liquidity. So when we have lows that are close in proximity like this, so you can see this low is close in proximity to this one, is also close in proximity to this one. This is what we call a layered liquidity in price. And this is an high resistance liquidity run because of the run in price lower, and same thing here, and same thing here. Now, is this a high resistance liquidity run or a low resistance liquidity run? Because in this example, the order flow is bullish, and that's what I actually want you to study. Right, I want you to study every short-term high in a bullish order flow and see price willingness to want to run for that liquidity versus not run for that liquidity. You can see here the market runs higher, makes a short-term high, runs lower. The market has no problem running for buy side liquidity. Same thing with this one here. The market has no problem running for buy side liquidity. Same thing as this one here. The market has no problem running for buy side liquidity. Here we have a short-term high. The market runs above that one. No problem, again, because the market trades up into that and then sees the market run lower. But I want you to watch this high here. Right, this is a special one. because prior to the run higher and then the reversal lower, we actually had a run on buy stop, right? So we had a short-term high that the market created, and then the market then ran through that short-term high and then run lower. So do you think the market is just going to run through the liquidity immediately? Of course not. Right, so you can see here it actually tries to get through PI and it fails and retraces lower into a discount, and then here it tries to get above the eye, but then it runs lower again before it finally runs through. Now compare the run on this liquidity to this one, or this one, or this one, or this one, or this one. And you can see the easiness, or the willingness in price when it displays for the liquidity versus this one. That's because the liquidity here is being deferred due to the nature of the short-term high that was formed. And you can use the nature of the swing high or the swing low in price to anticipate how the delivery cycle should actually occur. Right? So you can see here, you have a low here, you have another low here, very clean lows in price, and the market has no problem running through the lows there. Yeah, because those are very clean lows in price. Right, I'm trying to look for a more. This is also a low here. Very clean lows in price. Market has no problem running through the lows here. But this is a high risk in liquidity run, because prior to the run higher, we had the market go for stops. So whenever you see the market go for stops, there is always a probability that that could be a high risk in liquidity run, and there is a probability of a deferred kind of delivery for that objective. And one of the better example, which is something we actually documented with dollar, was I think that was during. Let's actually look at date price. So I want to find the actual date so you can go and watch the commentary. We're expecting. Yeah, I think it was somewhere around here. Was it? I'm actually looking for. There was this one time. I think it was April. Right? It was the month of April. And we're looking for a liquidity objective. I'm actually trying to find the. Okay, it was this one here. I think that was March. Alright, that was during the month of March. Alright, so that was the liquidity run we're looking for. It was this low here, where we have a swing low. So I'm using the again, and this is something you also want to add to your protocol. Whenever you're aiming for a liquidity, always target the bodies of the candle first. Always, always. There's no assurance that the market is going to run through the candlestick wicks. Again, remember, why do we target the bodies of the candle? Number one, the rejection block. A rejection block is a PD array for an objective, and number two, sometimes the market just only needs to run the rejection block for a run on liquidity, because the funds would have the bulk of their orders inside the candlestick bodies and not the wicks. Okay, because the bodies actually reflects true delivery on the interbank level versus the candlestick wicks. Alright, so this is something. So I want you to go and watch the commentary on 29th of March. Alright, go on 29th of March, watch the commentary, and we talked about this low being an high risk in liquidity run, meaning the market should see kind of like a difficult time running through that low here. Now, not this one, actually talking about this low here. Now, what we're looking for was we're looking for a run for the sell side here, and what we actually see is if I use the replay tool proper. Alright, so if I use the replay tool proper, what makes this low a high risk in liquidity run, even though we're looking for weakness in price? Alright, you can clearly see order flow is bearish. We're looking for bearish order flow in price. And what makes this low, even though it's in the path of this resistance, aka it is in the direction of the order flow, what makes this a high risk in liquidity run? look at the nature of this window prior to displacement higher. We have a short-term low here, and then the market runs lower. Sellers, sellers are going in price, looking to continue the shorts. So there are short-term sell stops in price who are chasing the sells. And then you have a displacement higher, and then a run lower again. And what this does is this traps sellers. So let's label this as sellers are trapped. Okay, so at that low there, we have sellers who are trapped. And then the market runs into a premium. We have sellers who are trapped here, aka we have sell side liquidity down here, right? So as the market, again, this is the objective liquidity we're aiming for. Why is that the objective liquidity we're aiming for? Because that's where we have external liquidity relative to the range between this low here and this high here. That's where we have external liquidity. So again, we have this liquidity down here, and because we have defined this as a high resistance liquidity run objective, we can expect, again, we logically want to see the market expand lower, but if we see the market not start to offer that run lower, then we can expect that the market might want to defer the delivery for a later time and then build in more liquidity. So now let's watch delivery price. So this is a Tuesday, right? So we have a Monday here, we have a Tuesday here, and what actually sends out on Tuesday is this gap in price. Right, so we have a Tuesday and we have this opening gap, and then the market runs lower. Now, what do we expect when we see delivery like this? And this is something I've talked about, and I'll kind of like segue into this also topic too, which is whenever you see the market leave a recent price range, what you're looking for is what we call range expansion. So if you have an objective, which is down here, we have an objective liquidity down here that wants the market reach for it, because that's external liquidity. And then we inside that external liquidity, we have internal liquidity, which is a liquidity inside the range or inside an existing price range. And external liquidity is a liquidity external to an existing price range. So relative to the low here and BI here, every short-term high and low, that's an internal liquidity. And then the external liquidity rests above the rejection block and this high of the candle, and the rejection block and the low of this candle. That's where external liquidity actually rests. Now, when we see the market run a short-term low like this, we typically do not want to see a retracement back into the range, especially if we have an external liquidity in close proximity to that internal liquidity. This is a very important detail. So what we want to see classically when we expand over range is we want to see range expansion, so meaning we want to see the market spread its wings. So let me show you what that looks like. Alright, so I'll open a new tab and let me just do some trades. We're gonna use USDCHF, or yeah. Now you can see here we have an existing range, which is this low here and this side up here. That's an existing range, right? And we have the target trend liquidity, and this is how you can utilize, or this is how you can gauge liquidity runs. Our target trend liquidity is this low here, that daily low, where we anticipate fund level liquidity resting at. Now what we're trying to do here is we're trying to gauge the willingness in price to want to reach for that daily low here, down here. When we see range expansion like this, external to this range, this low here, this high up here, what we don't want to see within our time window is a retracement back into the range. If we are expanding out of the range, if there's a near term drawn liquidity. Now if there's no near term drawn liquidity, and again the keyword here is near term, if there's no near term drawn liquidity, then it's fine to expect a retracement back in the range and you're not going to look for a continuation trade. Now, this is specifically for a continuation trade in direction of order flow, looking for a target objective or liquidity. Or this could also be how you can scale out partials. It's also important for scaling out partials. And this is how scale out partials if I was taking a trade here. So let's assume I took a sell and use CHF here inside the small fair value gap, and I showed it there. Now obviously, as we get down below this range here, I'm going to take some profits off. But this is what I'm aiming for. I'm aiming for this daily sell liquidity down here, which is my overall objective liquidity. And what I'm doing down here is I'm gauging the willingness and price to want to see range expansion, meaning I do not want to see the market return back into any premium of the range. Okay, so as we run below this range here, I want to see price show me a willingness to want to expand and leave that price range and be priced into the next pool of liquidity, which is the one at 0.8940. And because that's a daily low, obviously you look for a run in terms of 5, 10, 15, 20, 25, and then 30 pips, which is what you see here. We run through that daily low by 30 pips, and that's how you get your 0.8910. Right, that's what you're looking for. Okay, but here you can see that as we run through the sell stops here, look at what the market does. Aggressively reprices back into the range, and it does so with speed. Now when you see something like this, if you have defined this as a low resistance, as a high resistance liquidity run, you don't go in here looking for continuation trades. You don't go in here looking to sell this as a mitigation block or as a bearish block, because there is a very strong probability that the market will defer the delivery for this low to build in more sell side liquidity. All right, especially if you see lower time frame a bullish order flow. Now obviously on the high time frame looking for a bearish order flow. This is our New York session here. This is the end of New York session here. And what you can see here, London was bearish, running for that sell side. We still have an overall objective liquidity at 102.14, and what we're measuring is price willingness within a time window. Okay, and the time window is it's New York session or London close for 29th of March. That's what we're watching. And you can see here, what does the market do? It trades down into bullish block and sees range expansion. Does this look like bearish order flow being delivered? Of course not. So what does this mean in price? It means we're probably engineering more sells at liquidity pool here, so you don't go in looking for sells. Right? You can anticipate some kind of internal liquidity to get taken out. And what is the nearest internal liquidity we have? That's going to be this eye up here, and then this one here. So now let's watch what the market does. And you can see we go in and run buy side liquidity. Okay, now do you go in here and look for short during London close? No, you don't. Why? There's no indication we're delivering sell side. Look at this small little fair value gap. Look at the way we completely traded through that fair value gap. There's no indication of bearish delivery. And this out, you also utilize order flow to gauge the willingness in price when I run through a liquidity pool. Now this obviously is lower than liquidity run because we have a relatively clean lows here, right? And this is what we call engineering open flow liquidity. Path of least resistance is this one. So now what the market usually would do is around high resistance liquidity runs like this, it will build in a low resistance liquidity run. And then when the market starts to run for that low resistance liquidity run, it will then make the high resistance liquidity run a low resistance liquidity run. And I'm sure it does not make sense what I'm saying, but you'll see what I'm saying. Alright, so now you can see how that old fair value gap was used to deliver longs. And we eventually run higher for that buy stop from Tuesday. And after running through the buy stop on Tuesday, this is the end of London close. Here we start to see lower delivery. I want us to go into the next day, which is Thursday, and this is the new day opening price, which is Thursday, and this is the start of London session and the end of London session. Now I want you to see price delivery. All right, so we've run above this eye here. What do you think is going on there? Do you think anyone's so bearish? No, of course not. They're not all bullish. Everyone is not bullish because we have support here. We've seen a breaking structure, and the anticipations of higher prices from here. All the market was doing was building in more open flow liquidity on the sell side due to the nature of the overall liquidity it wants to reach for, which is a high risk and liquidity run. Okay, so during the New York session, now look at what order flow looks like. We have a bearish block here. The market trades up into the bearish block. What are you looking for? You're looking for displacement. You get the displacement, right? Does it lose a bearish block? Again, that's that old fair value gap. It does not. What does this mean? Sell side liquidity is the objective. Now let's see if it runs sell side liquidity. Can you see that the market actually runs sell side liquidity here? Eventually does so. What was going on here? This liquidity was being engineered, and this liquidity here was being deferred. So we would anticipate that heading into New York session, we should at least see that liquidity being ran. And let's see what happens heading into New York session. Alright, so the market trades up into the balance price range here. And can you see the market runs liquidity eventually? Right. What it does here, this is the overall liquidity it was going for. But what it did in the process was to engineer more sell side liquidity by deferring delivery, right? Which is classic of a high risk and liquidity run. All right, so classic of high risk and liquidity run is engineering open flow liquidity by deferring delivery. So sometimes you know you're trading in the direction of the order flow, but you're wondering, why is this target objective not being met? That's because the market is just deferring delivery for a little time. And if you don't understand this concept, if you don't understand what I'm saying, you will force multiple setups. And what this actually does, it saves you from losses, number one, helps you take profits better, number two, and helps you avoid trades that are not at the right time. Like, how many times have you had the buys and the only problem was you were executing at the wrong time or the wrong day because you did not understand the concept of liquidity you're trading? And that's what this video hopefully should help you out in terms of identifying high risk and liquidity run signatures. And you can see here we have a short-term buying price. The market runs above the short-term high, trades lower, retraces back up into a premium, expands lower. Did we run this out here in this run higher? No, we don't. Did we run it here? No, we don't. We eventually run it up here because this is a high risk and liquidity run. But this makes a high and makes a lower high here. Do we have any problem running through this high? No, we don't. Right? We run for the objective during the New York session because this is a low risk and liquidity run. But this is high risk and liquidity run, so we know the market would want to build open float liquidity on the buy side. That's why it goes up here and then runs lower, and that creates buy side liquidity up here. And then you have this as a high risk and liquidity run, and then you have this as a low risk and liquidity run, and then you also have this as a high risk and liquidity run. So you know the market should ideally run higher if you start to see bullish order flow. But that run higher is only to engineer sell stops by running above a short-term high, inducing longs, and trapping sellers or neutralizing sellers. Alright, so hopefully this video was insightful, and I will see you all on the day trading course or the day trading module. Safe trading.